Back to our top-line conversation right now. Not everybody is on board with the possible Bank of Canada interest rate hike. For more on this and whether Canada is looking south of the border for cues on whether to raise or not, we're joined by our featured guest, Diana Avigdor, Head of Trading at Barometer Capital Management. Diana, good to be with you today. Thanks for coming in. A lot to discuss with respect to the potential for an interest rate rise. First off, do you think that the governor of the Bank of Canada should raise rates this Wednesday?
I don't think he should. Simply because you just mentioned this poll. Markets already and regulators are already working to slow down our housing market, which housing and housing-related things play into 30% of Canadian GDP. And that 3% GDP growth number that everybody is throwing around as an excellent growth number for Canada, which is great. Actually, 3% was a bit of a surprise, given what the commodity markets are doing. Why is the Canadian market growing at 3%? That's so high. But if you're going to slow down housing, and then you're going to raise rates, and I get why. He's been hawkish. He's been dovish for way too long as the data was coming in positive. Canadian dollar was the most shorted currency out there. Canadian market is one of the lowest skirting return equity markets globally of the developed markets. All at once, all in a month, I think that it would be good if it was taken a little more slowly. In terms of expectations, I think you mentioned that it's already priced in. Maybe if the rates do go up coming Wednesday, maybe nothing happens further to the Canadian dollar, as it's already rallied so much. But it really is a mixed picture with mixed feelings as to whether it's beneficial or not. Canadian rate differential between Canada and the U.S. are really quite wide. So Mr. Poloz could take the opportunity to tighten them a little bit now. And maybe it helps out some of the banks in terms of steepening the yield curve in Canada. It might offset some weakening in the mortgage market if what we're talking about in terms of affordability actually plays out. But you got to be careful what you wish for and how fast you do this tightening, because what's happened in the housing rules and so forth, that's already a de facto tightening. And RBC raising mortgage rates, that's already a de facto tightening.
So the risk is the contribution that housing has to the Canadian GDP, and then also, of course, the consumer. And as we pointed out, and we were just talking about, everyone's own personal balance sheet. That's the risk.
So be careful what you wish for, because the 3% GDP growth could be something that's in the hindsight mirror that may not actually materialize going forward. We really need to take the country and boost it economically, given what's happening in the commodity market.
I suppose as well, though, Diana, that if you wait too long, like we all know around the world, that these increases in assets, I don't necessarily want to say asset bubbles, but that they increase, and at some point there will be a reversal. So there is the suggestion that perhaps Stephen Poloz does get ahead of that curve and try to maybe import inflation to a degree, which they would be doing by increasing the Canadian currency, and that's going to temper household spending and temper the housing market. So it could be exactly the right move, but there's the risk to overshoot.
But it's a little fast, right? Because a month ago, a fast switch, the great turnaround here, because a month ago, only the negative of the economic data was being highlighted in an attempt to keep the Canadian dollar weak so that it could boost our other side of the equation, the exports.
So what do you think really happened? Why do you think it's a fast change of tone and direction? It seems, right?
It really is.
But Diana, or at the same time too, maybe we're just so used to central bankers giving us the heads up for 2 years prior to doing anything, and even then the 2 years gets extended, i.e. the Fed. So maybe we're just so accustomed to slower central bankers.
You know, and 100%, you're right, maybe. And should the punch bowl be taken away, like, you know, in 24 hours? But really, this last 8 years has been a really different kind of phenomenon with this easy money given by governments, mind you, because the corporates were not feeling easy money with all the regulation and all the rules. So on the one side, it was easy money, which boosted housing and so forth. But on the other hand, corporates were not making all that money. Look what's been happening to the financials in the U.S. Only now is the leash being loosened a little bit, and they're already starting to reflate. It's just, I'm not saying no, but I'm just saying the switch is a little bit fast, and it's just you got to be careful what you wish for on how quickly and how fast you tighten the belt. Certainly, you want to close out excesses, and but that being said, inflation is much easier to fight than deflation. We have monetary tools to fight inflation by raising rates whenever it's needed. The opposite is not true.
Which means what to our viewers?
Which means that we want to make it's okay if there is a little bit of inflation. Is what I'm trying to say. Is that we're not in a situation where we're at high rates. Actually, up until 5%. So I'll offer this to our viewers.
Okay.
I'll say, low rates and low PEs mean high risk actually, and uncertainty. This is why the low rates and low PE, and that's why the easy money. As rates go up, and as we've been talking here between us, rates in the U.S. going up, at this point it's not a bad thing. And it won't be bad for Canada either, except Canada, it's a little different situation with they've already taken steps to slow down the housing market, and mortgage rates have already started inching up. So already they put in the mechanism to start working. I'm just saying it's fast. So higher rates, higher PEs actually means less risk at this point, more stability, companies understanding the normalization of the cycle, and so things actually do get better. And actually studies on the correlation between rates and stock market, it's positive up until about 5%.
Right.
Because it's going from 1% to 5% for all the right reasons. And then only above 5% do you start battling this inflationary, too fast, too much, let's close in excesses. So the point is we're not in excess situation here.
So, but that's an important point to make, that when rates rise up into the 5% mark
Or so, yeah.
That's always been viewed or taken as a positive in the market, that the markets can keep moving higher. And the reason why that's important is because I think there's a lot of people that are sitting back and going, what happens to the valuations? We've seen that play out on the FANG stocks. Those FANG stocks come down when we think that the rates are going to move higher in the United States. Yeah. But you're saying, look, it's going to probably be volatile, but they can all move higher.
Yeah, as long as earnings.
As long as earnings.
Because the reason rates are going up is because things are normalizing. Normalization means companies can do what they need to do.
Yeah.
You have unemployment rate at lows, and even wages are starting to inch up a bit, not fast enough for some.
But it comes down to whether or not the data that we're looking at and that the Bank of Canada is looking at is truly accurate in saying that things are getting better.
Yeah.
If they're wrong, everything we just talked about is a reverse of what we said.
Yeah.
Okay.